Now, we have an economy that has gotten extremely used to, some would say addicted to or dependent on ultra low interest rates. That the Fed brought them down to zero at a period of time and kept them really low, lower than they'd been in some cases in recorded history. And the system habituated to that. So now that rates are rising, they're rising pretty dramatically, right? We've gone from near zero, now we're around 3%. We're going higher. The Fed is highly likely to hike another 75 basis points at their next meeting, and is talking about going even higher still. And we've raised rates faster than we ever have in the data series. So think about, the way I like to help people understand this is, let's say I gave you, Robert, a gallon of water, and I told you you had a week to drink it. You'd have no problem with that, right? But let's say I just shoved it up against your face and I just forced it down your throat all at once. You might actually choke and drown, right? Same amount of water, but it's the rate of change that's the different point there, right? So we're shocking the economy right now by bringing rates up to a point where the economy is not used to rates being this high, may actually not be able to function at rates this high. And we've done it in such a fast period of time that it's literally like shocking the financial system here. So the conventional standard pricing of the bond market basically kind of gets stood on its head, which is you would normally expect higher yields to be charged for longer duration debt, but instead it's the shorter term debt that is charging the higher yield. And the reason for that is, as we mentioned, is it's basically the bond market telling you that it's nervous about the short term. And as we were finishing the last segment before the break, I was talking about how fast the Fed has been hiking interest rates. And essentially what the inverted yield curve is telling us is that it agrees with the people who say that, you know what, the Fed's going to keep hiking rates until, quote unquote, something breaks. And the inverted yield curve is the bond market saying, yeah, I agree. I think something's going to break in the near future. And that's why I'm charging higher rates on demanding higher yields for the shorter term debt. So what that tells us is, okay, hey, we should all be, a little bit more cautious, a little bit more defensive right now that, we may be going into a recession because an inverted yield curve is one of the most dependable signals we have of recession. And then we should just be saying, hey, if the Fed breaks something, well, what's likely to happen, right? And this, Robert, is where we get into, are bonds a good place to be or not? And it gets a little complicated, but I'm going to try to keep it really simple. And this is probably why your friend Harry Dent really likes U.S. Treasury bonds right now. I personally find it hard to make a great case for muni bonds right now. And of course, I'm making a blanket statement, just like with stocks, not all stocks are created equal. I'm sure there are some great muni bonds out there right now. But there are a lot of risks going on that I think, that you take on as a municipal bond investor that, given the current macro environment, I'm not too excited about. And I can get into that in a little bit more detail. Let me just contrast it to a U.S. Treasury bond and a corporate bond. So U.S. Treasury bond is basically you're just borrowing from the government. Right? And that's how the government finances how things work, right? So they agree to pay you back on a certain schedule with a certain interest rate. Great. And your risk there is really the sovereign risk. Will this country be in business long enough to pay me back? Then there are corporate bonds, which is basically where a company is doing the same thing, borrowing your money, agreeing to pay you back on a certain schedule. And in most cases, you're going to demand a higher interest rate or rate of return on a corporate bond than you will a government, because it's much more likely the U.S. government's going to be around than random company X. Now, a municipal bond is a local government that's borrowing from you. This is oftentimes how, bridges get built and, policemen get paid and, things like that, is the local municipality borrows from you and agrees to pay you back on a certain schedule. But you have all sorts of additional risk that go on there. You've got the risks of what happens in that locality. If we have a national recession, is this a area that's going to get hit worse or less by, what's going on? Are people moving in or out of this place? Are they going to raise taxes or lower taxes? There's all sorts of other risk factors that can go on there. So you can get tax benefits from them, yes, but a lot of U.S. government bonds are exempt from state and local taxes, but not from federal taxes. A lot of muni bonds are kind of the other way around. So your mileage varies here. And I think just to put a cap on the muni space, if you're going to invest in a municipal bond, I would definitely do so under the guidance of somebody who really tracks them and can pick out the wheat from the chaff for you, because there are so many different variables that go on there. And one of the things we're going to talk about in a minute is this recession risk that the inverted U.S. Treasury yield curve is warning us about. I talk for a living on Wealthion. I talk to economists and investors and market analysts. I do it 5 to 6 days a week. And the vast preponderance of them are all pretty concerned about both the depth and the duration of this recession that it looks like we're heading into. So, a lot of people sort of think that, okay, well, if we get into a spot of trouble, the Federal Reserve's going to pivot, and they're going to do what they did back in 2020, right? In 2020, we had a recession, but boy, it was a very, very short-lived one, and then we got a ton of stimulus and beginning to tighten their balance sheet, which basically means they're withdrawing liquidity from the system. And this is after a decade plus of keeping interest rates super low and pushing liquidity into the system. We could have an entire show on kind of the bad policies that have been pursued that have gotten into into this huge trouble where we have way too much debt in the system, and it's killing our economic growth prospects. And the problem is if we keep using the old medicine to try to limp things along, we're just making the problems even worse. So if we try to, tighten our belts and try to, use austerity to try to, reverse the worst of what we've created, we actually start sending the system into shock and it starts threatening to collapse. So we don't really have a good road to a good path to go down, whichever path we pick here. How much time do we have, right? And it really depends on where you are in the story, right? So some players have a lot less time than others. Other countries are going to fail first before we do. Other countries, other currencies are going to fail first before we do. Yeah. So, if you're looking at let's look at currencies. Right now, the other world major currencies are having a much worse time than the US dollar is, right? The Japanese yen is basically in free fall right now. I think it's lost definitely more than 40% of its value over the past year, maybe even more right now. The euro has gotten down to parity, below parity even with the dollar. The pound has almost gotten to parity. It hasn't been there for decades. So we're already seeing other players stumble harder and faster before us. And you had talked about the dollar milkshake theory that Brent Johnson mentioned. And I'll try to keep it really simple for folks. Good. What it basically says is that as the rest of the world stumbles, and they are more likely to stumble first before we do, and probably worse than we do, that creates a global demand for dollars. Right. And that props up the value of the US dollar. And that's exactly what we've been seeing this year. I just told you how much it's appreciated versus all the other major fiat currencies. So if you own any other currency besides dollars, your gold has appreciated dramatically in your local currency. Right? It's only in the US that it hasn't. And that's because the dollar has been so strong this year. And that's because of the dollar milkshake theory. So I emphasize that because there's a lot of people who ask a lot of the same questions you were asking, Robert, which is, well, all right, so I heard this thing about Saudi Arabia and we've got all this debt, and so is the US dollar just going to become toilet paper overnight? Basically, the dollar milkshakes theory says, look, like it or not, and Brent Johnson is not a fan of the US dollar. He thinks there's a lot of problems with it, but he just says it is the cleanest shirt in the dirty shirt laundry hamper. And we have a lot of advantages still some of them fair, some of them unfair, that are likely going to prop the dollar up for an awful lot longer than most people imagine. He says at some point in time, yes, there will be a reckoning with the US dollar like there will be a reckoning with all fiat currencies, but it is highly likely to be the last domino to fall. And another part of the Dollar Milkshake series says that in addition to propping up the value of the dollar because there's this global demand for dollars, a lot of foreign capital is going to just find its way into the US market anyways, because it's going to be seeking stability, safe haven, and return. And so that's something that, as bad as what might be coming, is the US capital markets may actually fare pretty well on a relative basis because you just have this flood of outside capital coming in. Again, not necessarily very fair. And for those who have legitimate concerns about the US market and the US dollar and the US capital markets, it doesn't negate them, but it basically says in the relatively near to midterm, we may actually be the source of strength. Obviously, a really big one would be, if there was a competing currency on the global scale, something that could either remove the US's reserve currency status, or at least give a credible alternative that diminished demand for it. So like if you live in Japan, you have to be preparing for now. Like how much time do you have left? You've got an awful lot less time than the folks